Okay, if you're trading right now, you know this feeling. The sheer amount of market data, it's just a flood,
Oh,
isn't it?
absolutely. It's relentless.
Yeah, you've got fundamental news flying at you, technical charts blinking every second, huge macro shifts happening, and the pressure to find some kind of edge, to be faster, smarter, it's intense.
It really is. And trying to process all that manually,
Mm,
forget it. It feels like you need, I don't know, a whole team just to keep up.
exactly, like 3 desks and a research department working around the clock.
And it's not just the amount of data, right? It's the complexity needed for, well, for profitable decisions.
Yeah.
Think about options trading, for example. If you're doing strategies like, say, iron condors, or you're trying to dynamically hedge something,
Hmm.
you need instant calculations.
Hmm.
You need implied volatility, theta decay, delta exposure, all factored in right
Hmm.
now. Plus, you've got these dense regulatory filings.
Oh, those SEC filings.
Yeah, they're almost designed to be complex, you know?
Yeah.
It's just, it's often beyond what a human can analyze quickly enough to actually trade on.
Right. So that's exactly why we're here today. Welcome to the deep dive, everyone. We're aiming this squarely at you, the learner, to give you maybe the ultimate shortcut through all that noise.
Hmm.
We're diving deep into the insights from A. Cordero's ebook, AI Prompting for Smarter Trading Decisions. Think of this as the blueprint.
And our goal today, really, is to give you a practical toolkit. We want to show you how to take this idea of AI prompts, which can sound a bit fuzzy sometimes,
Yeah, it can.
and turn it into genuinely actionable trading insights, the kind that lead to better execution and hopefully better results down the line.
We've got 6 core use cases lined up, straight from A. Cordero's work. We'll walk you through the whole process, from asking a simple question to refining a strategy, even theoretically backtesting it, all using smart questioning.
That's the key. It's all about the questions you ask.
Now, the ebook does mention specific advanced tools, things like Grok or the architecture from XAI. But honestly, the principles we're discussing today apply pretty much across the board to advanced language models.
Exactly. We're talking about AI that can bridge that huge gap between just raw data, the stuff that swamps most traders, and actual informed action.
So this deep dive isn't about plugging one specific AI tool over another. It's about mastering the technique of asking the right questions. It's about using AI to do analysis in seconds or minutes that might take a human researcher days or even weeks.
Right. The focus is squarely on how you craft that prompt. You need to understand why the AI's answer is potentially better than just using a basic stock screener.
And why is that?
Because a good AI response synthesizes everything. It pulls together the technical picture, the fundamentals, the risk factors, all into one sort of holistic trade plan. That's the value proposition.
Okay, let's get into it then. First up, trade idea generation. This is probably where you see the most immediate benefit from AI, right?
Absolutely. It's your instant scanner.
It scans technical patterns, it identifies which sectors are hot, it flags fundamental stuff that maybe even a really dedicated swing trader might miss just because there's so much going on.
Exactly. Look, the AI doesn't need sleep. It doesn't get emotionally attached to a stock it liked last week.
Ah, yeah, good point.
It's just tirelessly scanning charts 2047, applying dozens of filters at once. So what does that mean for you? It means your time shifts. You're not spending hours manually scanning charts anymore.
Right.
You're focusing your energy on execution, on managing the risk, the higher level stuff.
Okay, the ebook gives us a really great kind of raw example of this. The prompt was super direct. Give me 5 swing trade ideas based on technical breakouts in large cap tech.
Straightforward.
And the simulated answers based on data from October 2025 in the book were immediately useful. Why? Because the AI didn't just spit out stock tickers. It gave the whole plan.
And that structure is key. It wasn't just the name, it was the why and the how. Every single suggestion came with like a built-in 3-to-1 risk-reward profile.
Which enforces discipline right away.
Right. It forces that mechanical thinking from the get-go.
Okay, let's look at the specifics. First one flagged was NVIDIA. Clear breakout above $150 resistance.
Yep. And confirmed by high volume. The AI explicitly linked it to the ongoing AI chip demand story.
And the plan. Enter long at $152, target $165, stop loss at $145. Very precise.
And think about that stop at $145. Why there? Because $150 was the level it just broke through.
Ah, the prior resistance.
Exactly. So the AI is thinking, okay, if it falls back below that old resistance, especially below $145, the breakout's probably failed. The thesis is busted.
So it quantifies the failure point for you.
Precisely. Saves you from just guessing where to put your stop.
Yeah.
And that specific setup offered about 4 units of potential reward for every 1 unit risked. Pretty decent.
Then there was Tesla, TSLA. It broke out of a consolidation phase around $350.
And again, the AI connected the dots. It linked that technical move to the narrative, renewed EV market optimism, positive earnings momentum. It wasn't just lines on a chart.
The plan there: buy at $355, aim for $380, stop at $340.
C. Multi-factor analysis. The technical move isn't happening in a vacuum. It's got fundamental support. Now look at Palantir, PLTR.
Right, PLTR surged past $50.
Driven by news, big government contracts. But technically, the AI spotted a classic cup and handle breakout. That's a strong bullish pattern.
And the trade plan?
Long entry at $52, target $60, stop at $48. Again, very specific levels.
And that one, based on the AI's analysis of that pattern, offered something like 8 times the potential reward versus the risk.
Yeah, potentially a very strong upside move if that pattern played out. Huge edge if it works.
Similar story for Shopify, SHOP. Breakout above $80, and the AI noted the RSI, the Relative Strength Index.
Confirming the strength, right?
Yeah.
Suggesting the momentum wasn't exhausted yet?
So enter at $82, target $90, stop at $78. All fueled by the underlying e-commerce growth story.
And then, smartly, for traders maybe wanting broader exposure or less single stock risk.
It included the QQQ.
Yeah, the Invesco QQQ Trust, QQQ ETF itself, because the whole sector was strong. It crossed that big $500 psychological level.
So the plan was buy QQQ at $505, target $530, stop at $490.
And including the QQQ is clever. Like you said, it shows the AI understands diversification, even within a swing trade context.
Right. You capture the sector's move over that, say, 3 to 10-day hold.
But you smooth out the crazy volatility you might get from just one stock having bad news or something.
So the key takeaway here for you, the listener, really is this detailed, structured plan. It's got the rationale, the precise entry, target, stop. That's the value. Hashtag, tag, tag, B, sector rotation, and performance.
And that idea of sector strength leads us perfectly from single stocks to the bigger picture, the macro environment.
Yeah, because successful trading, especially macro-driven trading, often means figuring out where the money is flowing before everyone else piles in.
Exactly. You need to identify that sector rotation early. The source material really emphasizes how critical it is to quickly see which sectors are leading the pack.
So the prompt here was designed for that. Which sectors are outperforming the S&P 500 YTB, and what are 3 tickers in each? Simple, direct.
Right. Translates market data straight into potential allocation ideas.
And based on the year-to-date 2025 data used in the analysis, the S&P itself had, a modest rise.
Yeah, modest compared to the leaders the AI picked out. It instantly identified 3 sectors really crushing the benchmark.
Okay, number 1.
Healthcare, up a significant 8.76% year-to-date. The AI pinpointed why. New biotech stuff, plus the whole aging population demographic trend creating demand.
And the tickers it suggested.
Big ones: Pfizer, PFE, Johnson & Johnson, J&J, United Health, UNH, household names really.
Okay, next.
Industrials.
Oh.
Also strong, up 8.46% YTD. The drivers there: infrastructure spending, manufacturing bouncing back.
Makes sense. Tickers.
Caterpillar, CAT, Boeing, BA, General Electric, GE, core industrial plays.
And finally, the big one, I assume.
You guessed it. Information technology. Huge weighting in the index, like up to 34%. Consistently strong gains driven by, AI infrastructure and cloud computing.
The usual suspects.
Pretty much.
Yeah.
NVIDIA, NVDA, Microsoft, MSFT, Apple, AAPL.
So having this performance breakdown instantly, that's powerful.
It's invaluable. The AI aggregates all that performance data super fast. So if you're a nimble trader, you could potentially rotate capital out of sectors that are lagging, maybe utilities were weak, or real estate, and shift into these hot sectors.
Catch the momentum wave.
Exactly. Get ahead of the curve before the move is totally obvious to everyone. It's about trying to front-run the consensus a little bit.
Okay, so we've got ideas. Now, let's shift gears to precision execution. This is especially crucial if you're trading options, right? Because things get complicated fast.
Well, absolutely. Manually calculating option stuff,
yeah,
it's tough. You're battling the clock, price moves, theta decay. Making a mistake is easy and expensive.
Yeah.
This is where AI's speed is just indispensable. It handles those complex calculations instantly.
Right, because time is definitely the enemy with options. If you take 5 minutes figuring out your break even on a spread.
The market's moved. The implied volatility's changed. Your entry point is gone.
Right.
The AI gives you that mechanical precision you need to actually get the trade on and manage it properly.
Yeah.
Hashtag AR. Option strategy valuation.
Let's look at a really interesting comparison prompt from the book. It forces the AI to contrast two completely different options approaches. The prompt was, compare the risk-reward of selling a cash-secured put versus buying a AAP call on QQQ at current IV
Ah,
levels.
that's a great strategic question
Yeah.
because you're pitting two different philosophies against each other, right?
Yeah, so.
Well, the short put is typically a high probability income generating strategy, conservative-ish. The LEP call, though, that's about leverage, limited risk, but potentially huge upside, growth focused.
Okay, so the scenario used QQQ trading around $480 with implied volatility described as moderate, maybe 15–20% for those longer dated options. Let's start with the cash secured put.
Right. The AI suggested selling the March 2026 expiration $450 strike, and it calculated you'd collect about $20 in premium, so $2,000 per contract.
And the risk.
That's the key part. The AI lays it out clearly. Your risk is technically unlimited downside below your break-even point.
Which is the strike minus the premium. So 450 minus $20, $430.
It's exactly. Below $430, you're losing money. Yeah. If QQQ somehow went to zero, your max loss is $45,000 per contract minus the $2,000 premium you collected.
Ouch.
So the AI's conclusion, this strategy makes sense if you're bullish to neutral, you want income, and implied volatility isn't super high, more conservative.
Okay, now contrast that with the LAP call. Buying the March 2026, but a deep in the money $350 strike call. Cost was about $130 or $13,000 per contract.
Big difference in cost.
Yeah.
But look at the risk profile. Your maximum loss is capped. It's strictly limited to that $13,000 premium you paid.
Right. But the upside.
Theoretically unlimited. If QQQ goes to the moon, your profit potential is huge. The break-even is around $480 where QQQ was trading.
So the AI is really highlighting the asymmetry.
Precisely. The short put gives you income and a high chance of a small win, but carries that nasty tail risk. The LE costs more, fights time decay, needs a big move, but offers massive leverage with defined risk.
And what did the AI conclude for this moderate IV scenario?
It suggested the short put offered a slightly better risk reward for someone focused primarily on income in that specific environment. But it laid out the pros and cons of both very clearly.
Okay, what about more complex spreads, like an iron condor? Those have 4 legs. Calculating breakevens manually is a pain.
A nightmare, yeah. The prompt asked the AI about a near-term iron condor on SPY.
And this really shows off the calculation power. SPY was trading at $582.41. IV was low at 10%. The AI looked at selling strikes way up in the 670s and 690s.
Right, resulting in a pretty small net credit, only about $0.47 or $47 per contract.
Wait, hang on. SPY at $582, but the strikes are almost $100 higher. For a near-term trade, that seems really far out.
It does, doesn't it? But that's likely the point of the strategy shown in the source. With such a tiny credit, this isn't about making a lot of money. It's an extremely high probability play.
So it's purely about theta decay, time decay.
Exactly. It's a bet that SPY will stay within a very wide range, far below those upper strikes, for a short period. The strikes are so far out of the money that the probability of the price even touching them is tiny. Maximize probability of keeping the small premium.
Okay, got it. So even with those weird strikes, the AI instantly gave the key numbers.
Yep. Lower break-even, $674.53. Upper break-even, $685.47. Max loss, if SPY somehow exploded past that range, $453 per contract. Max profit, that tiny $47 credit.
So it shows how that neutral strategy works best in low volatility.
Right. But the real value the AI adds here isn't just the static calculation, it's the what-ifs. What if volatility suddenly spikes? The AI could instantly tell you how much your vega risk increases, how the premium might balloon, how your max loss changes.
It handles the dynamics.
Exactly. That instant calculation, adjusted for real-time conditions, is crucial for managing complex options mechanically. #, B-risk management, and position sizing.
Okay, let's talk about maybe the most critical piece. Risk management. We said earlier, AI is vital for avoiding those account blowups.
Absolutely fundamental. You can have the best trade idea in the world, but if your position sizing is wrong, you're eventually going to get wiped out. It's just math.
So we need that translation, right?
Yeah.
Going from, I want to risk X% to, okay, that means I buy Y shares or sell Z contracts.
And the AI provides that instant, rule-based discipline, takes the emotion out of sizing.
So the example prompt was, I'm risking 2% of my $500 K account on a trade. What is the max premium I can collect selling 0 DTE puts, 0 days to expiration? Very risky.
Right. First step, simple math. 2% of 500K is $10,000. That's your maximum allowed loss on this trade.
Okay.
Now, the tricky part is translating that $10K risk limit into selling 0 DTE puts. The AI has to consider the options delta, how sensitive it is to the underlying price move. For those far out of the money, super short-dated puts, delta might be low, maybe 0.2 or 0.3.
So the AI uses that delta to figure out how much premium you can collect while keeping your potential loss under $10 if things go bad quickly.
Precisely. The analysis showed, depending on the exact strike in delta, the max premium you could safely collect was around $2,000 to $3,000.
And that translated into how many contracts?
About 5 to 10 contracts, assuming you're collecting $2 to $3 per option contract. It gives you a concrete number based on your specific risk tolerance.
That enforces discipline, stops you from just YOLOing into too many contracts because you feel bullish.
Exactly. And this discipline extends to more complex stuff, like dynamic hedging. Think about managing a short straddle on the SPX index.
Okay, short straddle. That's selling both a put and a call at the same strike, right? Betting on low volatility.
Right. You profit from time decay, theta, as long as the market stays quiet. But if the market makes a big move, up or down, you can lose a lot fast.
So how does the AI help hedge that?
It simulates the adjustment needed. Let's say you sold the 3,000 strike straddle. The market rallies 1%. Suddenly, your overall position delta isn't neutral anymore. Maybe it's become positive, like plus 0.5 delta, because the call gained value.
Meaning you're effectively long the market now.
Right. The AI's immediate recommendation would be sell 0.5 FTX futures contracts against your position. That instantly neutralizes the unwanted directional risk, bringing your portfolio back to delta neutral.
Wow. Okay, so it's giving you a real-time dynamic action plan for managing the risk as it evolves.
Exactly. It's not just a static rule. It's a live guide telling you precisely what to do when the market moves against your initial neutral bet.
Yeah.
Absolutely critical for managing short volatility plays.
All right, so finding one good trade isn't the whole story, is it? Trading happens in a bigger context.
Definitely not. The market's driven by everything. Global news, central banks, politics.
And this is where AI gets really powerful, I think. Its ability to digest huge amounts of unstructured data. We're talking news articles, hours-long Fed speeches, those super dense SEC filings.
And distill it all down. That's the key. A human trader could spend all morning listening to Jerome Powell or digging through a 10Q filing.
Yeah, easily.
The AI pulls out the key takeaways, the stuff that actually moves the needle on price, almost instantly. It frees up so much mental energy. #tag a macro and sentiment analysis.
Okay, let's look at an example. The AI's summary of market sentiment for the end of October 2025, based on the source.
Yeah.
This gives you that overall risk-on, risk-off feel.
Right. And the summary wasn't just bullish or bearish. It was nuanced. It said sentiment was mixed, leaning neutral to maybe slightly bearish with some early jitters.
And it gave specifics.
Oh, yeah. S&P 500 down 0.4%, NASDAQ down 0.8%. And crucially, it linked that NASDAQ weakness to specific concerns, profit worries, valuation fears in big tech, naming Microsoft and NVIDIA as weighing things down.
But the Dow was up.
Yep, Dow up 0.3%, supported by different stocks like Salesforce and Goldman Sachs. So not a uniform picture.
And the AI didn't just report the numbers, it flagged the reasons for the caution.
Exactly. It mentioned ongoing worries about future Fed rate cuts, only a 70% chance priced in by year-end, apparently, and pointed to U.S.-China tensions as a background risk. You get the whole context in a snapshot.
That synthesizing power really shines with Fed communications, doesn't it? The prompt was basically, what did Powell say last time that mattered for rates?
Right. And the AI zeroed in on the September 17th, 2025 FOMC press conference. Powell announced a 25 basis point cut, bringing the rate down to 4.25%. He said inflation was up but should cool off. Pretty standard stuff.
But what was the key insight the AI pulled out?
It was the nuance. Powell kept hammering data dependence. He very deliberately didn't promise more cuts were coming soon. And the AI flagged that the market read that lack of commitment as hawkish, even though he actually cut rates.
Because it killed the expectation of easy money continuing indefinitely.
Exactly. It removed that guarantee of more easing, which pushed longer-term bond yields higher. The AI cut through Powell's prepared remarks to find the signal that actually drove the market reaction. It was a powerful analysis. #TagB at any time. Analyzing SPACs and SEC filings.
Okay, this takes us into maybe murkier waters, due diligence, regulatory filings, especially with things like SPACs, special purpose acquisition companies.
Yeah, the Wild West sometimes. This is where AI acts almost like a junior legal analyst for you.
Because those filings, like a 10Q quarterly report, are just walls of text, right?
What?
Intentionally complicated.
And for a SPAC, its entire value often boils down to a few lines about how much cash is left in the trust and maybe some boilerplate risk warnings buried on page 73.
So the prompt was to summarize the latest 10Q for a specific SPAC, Churchill Capital Corp, IXS, CCIX.
And the AI instantly pulled the critical numbers. The filing date, August 13, 2025. The cash in trust, $302.3 million. The net income, $3.56 million YTD. And confirmation it was trying to merge with a company called Plus AI. The basic facts.
But the real value add was the risk flags.
Absolutely. A human might skim past the standard warnings. The AI highlighted the big ones immediately. 1, it's a blank check company with minimal operations currently. 2, its entire future depends on successfully closing that merger. 3, the massive standard SPAC risk potential shareholder dilution from warrants and the risk of shareholders redeeming their shares for cash instead of sticking with the merged company.
That dilution risk is huge, isn't it?
It's critical. The AI is basically saying, hey, even if this merger looks good, be aware that a flood of new shares from warrants or redemptions could crush the stock price. It's acting as your built-in risk manager, reading the fine print.
What about finding opportunities, like activist investors taking positions? The prompt looked for 13D filings and SPACs.
Right. A 13D means someone bought over 5% and intends to shake things up. The AI scanned for recent activity in potentially undervalued SPACs.
Find anything specific for that late October 2025 period.
It was apparently a quiet week for new filings in that specific niche, but the AI did confirm the general theme. Known activist funds like Starboard Value were still sniffing around for bargains, and firms like Cantor Equity Partners, known for targeting stacks, were active. It even mentioned a specific ticker, Apex, as one potentially on activists' radar.
So even without a brand new filing, it confirmed the ongoing trend and highlighted potential targets based on historical patterns and fund focus, stuff you'd have to manually track otherwise.
Exactly.
Yeah.
It surfaces those potential hidden opportunities or risks buried in regulatory data streams.
Okay, we've got the idea, we understand the context, we know how to execute precisely, and we've got risk controls. What's left?
Validation. Before you put real money on the line, you want some confidence that the strategy actually, works, historically at least.
Right. And this is where AI can theoretically backtest strategies for you without needing complex coding skills.
Yeah, traditional backtesting is a pain. You need special software, clean data feeds, programming knowledge. It's a barrier for many traders. AI lowers that barrier significantly. It lets you ask, hey, how did this strategy do over the last 5 years? And get an answer quickly. Hashtag tag take it, draw me win rates.
Let's take a popular option strategy. The prompt asks for the numbers. Explain the historical win rate of selling SPY puts one standard deviation out of the money with 5 days to expiration. Very specific parameters.
Super specific. And the results the AI pulled from the historical data, 2018, 2025 in the example, were pretty compelling.
What was the win rate?
Somewhere between 80% and 93%. Really high.
Wow. Why does it work so often?
Mostly theta decay, time decay. You're selling options that are relatively far from the current price with only a short time left. As long as the market doesn't crash suddenly, time is on your side, and the option value decays towards zero.
And the returns?
The average return per trade was cited as 0.5% to 1%. Doesn't sound huge, but if you do it consistently, the annualized returns quoted were in the 20% to 30% range.
That sounds amazing, but there has to be a catch, right?
Absolutely. And the AI doesn't shy away from it. That high win rate comes with the risk of occasional but potentially large losses.
When the market does crash.
Exactly. The AI explicitly flagged the significant drawdowns that happened during big volatility spikes, like in 2022. It stressed that you need enough capital to survive those infrequent but painful tail risk events.
So you get the attractive win rate, but also the crucial warning about the downside. Balanced perspective.
That's the goal. Honest assessment of risk and reward, hashtag DVIX mean reversion strategy.
Okay, let's look at building a whole strategy from scratch using AI based on a known market tendency. The prompt. Build a trading strategy that sells the VIX when it spikes above 25 and closes under 20.
VIX mean reversion. Classic concept. The idea is that volatility tends to revert back to its average level.
So when the VIX, the fear gauge, spikes really high, above 25, that usually means panic.
And panic doesn't usually last forever. So the strategy assumes volatility will eventually calm down.
How does the strategy work mechanically?
Simple rules, which is good. You monitor the VIX index. If it shoots up above 25, indicating high fear, you initiate a short volatility position.
How? Like shorting VIX futures or selling VIX call
Now,
options?
either of those typically works. You're betting that the VIX will fall.
Hmm.
Then you have a defined exit rule.
Yeah.
Close the position when the VIX drops back below 20, suggesting fear has subsided.
And did the AI find historical support for this?
It did. The backtest results mentioned showed around a 70% win rate over a 20-year period, and the returns per winning trade were often quite substantial, quoted as 20% to 40% per event.
Sounds great again. What's the risk this time?
The risk is that volatility doesn't mean revert quickly. What if the VIX spikes above 25 and then stays there for weeks or months?
A volatility regime shift.
Exactly. If you're short volatility in that environment, your losses can mount very quickly and become very large. So again, the AI highlights the need for strict stop losses, careful position sizing, which of course you could then ask the AI to help calculate based on your risk tolerance.
So it builds the strategy, validates it historically, but always comes back to managing the inherent risks.
This responsible analysis, it shows both the potential and the pitfalls.
Okay, we've seen some amazing things AI can do: find ideas, analyze options, check history. But just asking simple questions might only get you so far, right? To really unlock that top-tier insight, like the 93% win rate data, you need to get smarter with your prompts.
This is absolutely the key differentiator. This is where you go from just getting generic info to architecting specific, valuable insights that actually give you an edge over others using the same tool.
It's about moving beyond basic queries to, like, expert-level consultation through advanced prompt engineering. Hashtag A. Advanced prompt engineering techniques. Okay, technique number 1, contextual prompting. What's that about?
It's about giving the AI the full picture, not just asking a generic question, but providing all the relevant details about your specific situation, your existing trade, your portfolio, your goals.
Like giving your doctor your full medical history before asking for advice.
Exactly. The QQQ leaps example illustrates this perfectly. The trader didn't just ask, should I sell my QQQ calls?
No, they provided context.
Right. I've got these late fees at $90. They're now worth $130. My specific goal is to double my capital in the next 12 months. What should I do? See the difference?
Yeah, much more specific. So how did the AI respond differently because of that context?
It didn't just give a simple take profits answer. Because the goal was doubling capital and the outlook was bullish, the AI gave nuanced advice. Okay, lock in some profit, maybe sell 50% to reduce risk given the nice gain, but then consider rolling the other 50% to a higher strike price.
Why roll higher?
To maintain leverage and keep aiming for that double your capital goal, but with less initial capital at risk now. It tailored the strategy to the specific goal and current position.
Very cool. Okay, technique number 2, chain of thought prompting. Sounds fancy.
It's powerful. You basically force the AI to show its work. You make it explain its reasoning step by step, not just jump to the final conclusion.
Why is that useful?
Transparency. It lets you see how the AI reached its answer so you can judge if the logic makes sense. It prevents it from giving you a black box recommendation.
Okay, give me an example.
Let's use the volatility example again. You ask, explain how a rise in the VIX impacts my short 0 DTE puts on SPY. Instead of just saying it's bad, you force the chain of thought.
So the AI would have to say,
Step 1. VIX rise means implied volatility is spiking, market fear is up. Step 2. Short-dated options are super sensitive to IV, so the put premiums inflate dramatically. Step 3. As premiums inflate, the put's delta becomes much more negative faster. Step 4. Therefore, your risk of a large loss or getting assigned the stock early increases exponentially even with a small drop in SPY.
ah, I see. Breaking it down like that makes the risk crystal clear. You understand the why.
Exactly. It builds comprehension and trust in the analysis.
Mhm.
Okay, final technique, role-based prompting.
This sounds fun. Assigning the AI a personality.
Sort of. You tell the AI to act like a specific type of expert, adopting their philosophy and style. This shapes the kind of advice you get.
The example prompt was great. Act as a tasty trade-style options coach. What's the best way to manage a tested short strangle on IWM during a low IV environment?
Perfect. You're explicitly setting the expectation. You want advice that's mechanical, high probability, focus on managing trades by the numbers, typical of that style.
And did the AI play the part?
It did. The response was straight out of that playbook. When a strangle gets tested, meaning the price moves towards one of your short strikes, roll the tested side, the put or call under pressure, out to a later expiration date and adjust the strike up or down. The key goals: collect more premium to widen your break-evens and reduce risk, and stick to your mechanical profit target, like
Yeah.
50% of the max profit. No emotion, just mechanics.
So by setting the role, you tailor the output to fit a specific desired trading philosophy. Hashtag tag hashtag B, essential best practices.
So, pulling it all together, A Cordero offers some core rules, like a checklist for getting the most out of AI consistently. These should probably be part of your routine.
Okay, rule number 1.
Specificity is paramount. We've hit this already, but it bears repeating. Vague prompts get vague answers. Be precise. Numbers, tickers, timeframes, your account size, your exact risk tolerance. Put it all in. Garbage in, garbage out, truly.
Rule 2.
Always define the goal. Tell the AI what you're trying to achieve. Is it income, growth, hedging, maximizing theta? It can't optimize for success if it doesn't know what success looks like for you.
Makes sense. 3rd.
Iterate and dig deeper. Don't just accept the first answer. Ask follow-up questions. What if 4V collapses? What's the risk if the Fed hikes unexpectedly? How would you manage this if it goes against me immediately? Push the AI. Explore the edge cases, the failure modes.
Get the full picture, not just the rosy scenario. And finally,
Systemize your success. This is about efficiency. Save your best prompts. The ones that are really specific, highly contextualized, the ones that give you great insights. Save them somewhere.
like in Notion or Apple Notes, or maybe the AI platform itself has custom instructions.
Exactly. Build your own library of high-quality prompts. Treat them like valuable intellectual property. They are your repeatable edge, ensuring you get optimized output consistently because your input is standardized. Hashtag tag outro.
Wow. Okay, we have really covered a lot of ground today digging into A. Cordero's framework from that ebook. We saw how AI can give you that immediate edge with trade ideas.
Right, then move into precision execution for tricky stuff like options and managing risk.
Then how it synthesizes all that macro news and reads those dense SEC filings for you.
And finally, how it can even help validate strategies by looking at historical performance theoretically.
The core message from A. Cordero seems pretty clear. Using AI prompting well can really shift trading, moving it away from gut feelings and guesswork.
Towards something much more systematic, data-driven, and, well, precise. By mastering these prompting techniques, you really can gain an analytical edge that just wasn't feasible for most individual traders until very recently.
But we absolutely have to end with the crucial warning, the disclaimer that comes straight from the source material itself.
Yes, very important.
AI is a tool. It augments your abilities. It does not replace your own judgment. You are still the pilot. The AI provides the analysis, the data, the potential scenarios, but you make the final decision. You have to take responsibility. Always, always. Trade responsibly.
Couldn't say it better. And maybe think about this. If AI can instantly tell you the 7-year win rate of some super specific strategy, perhaps the real edge now isn't just finding data anymore. Maybe it's using these advanced prompting skill to get the AI to synthesize conflicting ideas.
What do you mean?
Like, what if you prompted it to combine a high probability income-focused strategy like selling puts with a high reward leverage strategy like buying EVs? And then asked it how to manage the combined delta and vega risk of that hybrid approach.
Building something completely tailored that balances different objectives.
Exactly. Building a truly hybrid portfolio optimized for your specific risk tolerance and goals. So maybe the final thought we leave you with is this. What boundary-pushing hybrid strategy are you going to prompt the AI to explore next?